When the phrase smart money comes up, we're talking about the large institutional players, hedge funds, pension funds, billionaire investors, and corporations who often have access to better information, a deeper analysis, and more patience than the average investor. And recently, these smart money players have been making some very noticeable moves, ones that could shape the market in the coming months. Investment, here's what you need to understand. First, whenever these institutions shift billions of dollars into or out of certain sectors, it's not random. And these aren't impulsive trades like the ones many retail investors make when chasing the latest hype stock or following the news cycle. These moves are calculated, researched, and usually positioned well in advance of a major trend. That's why keeping an eye on what they're doing is one of the smartest ways to gauge the pulse of the market. Second, most retail investors, meaning the average everyday trader, tend to react after the fact. By the time the headlines say tech stocks are booming or energy sector is collapsing, the smart money has already made their play. They were buying before the boom and selling before the crash. Investment. This timing difference is exactly why so many smaller investors feel like they're always one step behind. Now, let's talk about the specific moves. Recent filings, earnings calls, and large-scale trades show that smart money has been consolidating into sectors like artificial intelligence, clean energy, and real estate, while quietly trimming positions in areas that look overextended, like speculative tech and certain consumer goods. This isn't about predicting the next big hype. It's about observing where money is flowing consistently. If billions are entering a sector, there's usually a reason, and it's worth paying attention. Finally, what should you, as an individual investor, actually do with this information? The worst mistake is to copy blindly. Just because a hedge fund bought a stock doesn't mean it's right for your portfolio. Instead, treat smart money moves as signals. Ask yourself, why are they buying here? What do they see that I might be missing? Use it as a starting point to do your own research. Align it with your risk tolerance and diversify in a way that protects your capital. Because at the end of the day, everything makes the goal isn't to follow the herd. It's to position yourself intelligently so you're not reacting to yesterday's news, but preparing for tomorrow's opportunities. This is why investors need to stay alert right now. The moves being made aren't small, and if history is any guide, they're pointing toward significant shifts ahead. When people talk about smart money, they're pointing to the large investors who move markets, hedge funds, asset managers, pension funds, and billionaires who have the resources to conduct deep research before making a decision. These players often operate quietly, but their moves send powerful signals about where the market could be heading next. Investment. The reason their actions are so important is because they don't just throw money around randomly. They analyze economic trends, track company fundamentals. Investment often have access to information and insights that aren't obvious to the average retail investor. When they buy, they usually buy with conviction. When they sell, it's rarely out of panic. It's because they see risk ahead. By paying attention to their shifts, you're essentially seeing a roadmap to where big capital believes opportunities and dangers lie. Think about it this way. If billions of dollars suddenly start flowing into a sector like renewable energy or artificial intelligence, that's not just a coincidence. These moves aren't made overnight. It makes a good investment. They're planned months, sometimes even years in advance. And while it's impossible to know every detail behind those decisions, you can still recognize the pattern. Investment. If smart money believes that clean energy is going to dominate over the next decade, it makes sense to consider why. Is it government subsidies? Is it technological breakthroughs? Is it consumer demand shifting? A good investment. Understanding the reasoning behind these moves can give retail investors a valuable perspective, even if they don't have the same scale of capital. Another point to remember is that smart money doesn't always chase hype. In fact, they're usually moving in the opposite direction. When everyone is buying into a stock because it's trending on social media, then the big players are often quietly trimming their positions. When panic causes retail investors to dump stocks at a loss, that's when institutions swoop in to buy at discounted prices. Investment. They understand that real wealth is built by positioning early, not by reacting late. This is exactly why their moves are so influential. They're based on foresight, not emotion. For smaller investors, the takeaway is clear. Watching what smart money does can help you cut through the noise of daily headlines and emotional market swings. It doesn't mean copying trade for trade, but it does mean paying attention to the signals. When institutions start pouring money into a sector or exiting a trend, it's a strong hint that something bigger is coming. And while no one can predict the future with certainty, following the flow of smart money is often the closest thing to seeing the market's direction before it becomes obvious. Most retail investors, meaning everyday traders and individuals managing their own portfolios, tend to operate on reaction rather than anticipation. By the time they read a headline about a stock soaring or hear a news anchor talk about a hot sector, the price has often already surged. This isn't because retail investors aren't intelligent. It's because they usually lack the time, resources, and insider-level analysis that institutional players rely on. The problem is that reacting late puts them at a constant disadvantage. They're often buying when prices are already inflated or selling after panic has set in, which leads to losses or mediocre returns. Think about how market news usually spreads. Smart money makes their move quietly, building positions over weeks or even months. Then earnings reports, government policies, investment, or industry news start catching the attention of analysts. Finally, the media covers the story and retail investors jump in. At that point, the upside is often limited because the market has already priced in much of the opportunity. The same happens on the downside. Institutions might reduce their exposure to a sector weeks before trouble surfaces, while retail investors only sell after the damage is done. This cycle repeats itself over and over. The psychology of retail investors also plays a role here. Many are swayed by fear of missing out when a stock starts running up. Instead of asking whether the fundamentals support the price, they dive in because they don't want to be left behind. On the flip side, when markets drop sharply, retail investors often panic and sell at the bottom, crystallizing losses that could have been avoided if they had a longer-term view. Meanwhile, institutions are taking the opposite stance, selling into strength and buying into weakness. This timing gap is why retail investors can feel like the market is rigged against them. But the truth is, and it's not rigged, it's just that the big players are several steps ahead. They anticipate while most individuals react. Recognizing this difference is critical. Investment. Instead of chasing after headlines or copying what everyone else is doing, retail investors should slow down, study the moves, and think strategically. If you see a sector that smart money has been building exposure to, don't rush in after the price has already doubled. Instead, dig into the fundamentals and ask yourself whether there's still long-term growth potential. The goal is not to react to yesterday's news, investment, but to position yourself intelligently for tomorrow's opportunities. When smart money moves, it's not just about the act of buying or selling. It's about what they're targeting. The sectors and assets that institutions pour billions into reveal a lot about where they believe long-term growth or immediate opportunity exists. For example, if large funds start increasing their stakes in artificial intelligence companies, that's not a random gamble. It signals a conviction that AI is going to shape industries and generate significant returns over the coming years. Similarly, if money flows heavily into real estate investment trusts all rights while interest rates are stabilizing, it suggests that institutional investors see value in property markets that might rebound or remain resilient. These choices matter because they're not based on hype, but on rigorous analysis and long-term trends. It's also important to notice when smart money exits certain areas. If big institutions start trimming their positions in overhyped tech stocks or speculative assets, that's a warning sign for retail investors who might still be holding on, thinking prices will keep climbing. The quiet withdrawal of capital often precedes market corrections, and those who aren't paying attention end up reacting too late. Observing not only where money is going, but also where it's leaving, can protect investors from getting caught on the wrong side of the trend. These moves also highlight broader themes in the global economy. For instance, growing investment in clean energy and electric vehicles signals a bet on the future of sustainability supported by government policy and consumer demand. Increased interest in healthcare or biotech reflects confidence in demographic shifts, aging populations, and innovation in medical technology. Meanwhile, reducing exposure to cyclical consumer goods or speculative cryptocurrencies may suggest caution against sectors that are vulnerable to volatility or tightening regulations. Each of these shifts tells a story about what the smartest investors believe will shape the future economy. For individual investors, the lesson is not to blindly copy, but to interpret. If you see consistent smart money inflows into a sector, ask why. What's changing in the market? What's the long-term growth driver? Does it align with your own investment horizon? And understanding these signals allows you to make informed decisions instead of chasing short-term momentum, because ultimately the assets being targeted today often become the foundation for tomorrow's growth. Investment. Paying attention gives you the chance to position yourself early instead of realizing too late that the biggest opportunities have already passed. When it comes to following the moves of smart money investment, the biggest mistake an individual investor can make is to copy them blindly. Just because a hedge fund bought millions of dollars of a stock doesn't mean it's automatically right for you. But institutions often operate under different conditions. They may have longer time horizons, more liquidity, or the ability to hedge risks in ways that retail investors simply cannot. For example, if a fund buys into a risky sector, they might be offsetting that risk with options, futures, or positions in completely unrelated assets. If you were to copy that trade without the same protections, you could expose yourself to far greater risk than they're actually taking. That's why the smartest way to respond is not to imitate, but to interpret. Think of smart money moves as signals rather than instructions. Investment. When you see a pattern, like several funds piling into a specific industry, that's not your cue to jump in immediately. Instead, it's a reason to pause and ask questions. What do they see that the general market hasn't fully recognized yet? Is there a long-term growth driver in play, such as technological innovation or policy support? Does the valuation still make sense at current prices, or has the opportunity already been priced in? By approaching it this way, you shift from chasing trends to analyzing opportunities with a clear head. Investment. Another important step is aligning these signals with your personal strategy. Everyone has different goals. Some want long-term wealth building, others seek steady dividends, and some are comfortable with higher risk for potentially higher rewards. If smart money is moving into speculative biotech, but your goal is stable income, following them would likely put you off course. Instead, use their moves to learn about the broader market direction while sticking to assets that match your own financial plan. This way, you benefit from the insights without abandoning your strategy. Discipline is the real edge for retail investors. You may not have billions at your disposal, but you do have the ability to control your behavior. By staying patient, diversifying wisely, and avoiding emotional reactions to every market swing, you can use smart money activity as a compass rather than a crutch. Ultimately, the best response isn't to replicate what the big players are doing, but to let their actions sharpen your own decision-making process. That's how you turn their signals into sustainable advantages while still investing on your terms.